Hello, everyone, and welcome again to Nettle, the best platform around for distance learning in business, finance, economics, and much, much more. My name is Saba, and today we're discussing interest rate risk management in financial institutions, banks in particular, and two main ways that banks can follow to reduce their interest rate exposures in terms of various types of interest rate risk. Earlier on, we already discussed net interest income exposure and economic value of equity exposure. And with regards to the latter, we investigated the concept of duration and how to calculate it for various types of assets and liabilities with varying profiles of their cash flow schedules. But all right, if the bank can measure its interest rate risk exposures either in terms of net interest income or economic value of equity, what can it actually do to reduce or completely mitigate, immunize itself against potential interest rate changes and adverse impacts it might have on banks' financial performance and its resilience? That's exactly the topic of our today's video. And it is very nicely aligned with derivatives as a set of topics that we have been investigating recently in a lot of detail. We discussed options and credit default swaps, and it turns out that another type of swaps can be used to hedge interest rate risk and immunize banks against interest rate changes. The derivative that banks extensively use in external hedging of their interest rate risk is interest rate swaps. But without going too far ahead of ourselves, let's first consider a simple example of a bank with made up numbers and figure out how can it actually manage, how can it actually protect itself against interest rate risk using derivatives, and later on, how can it do it without resorting to any external hedging, any external derivatives or other financial instruments? How can it immunize itself using just asset and liability management, so internal hedging? So imagine a bank with a certain mixture of rate sensitive and rate insensitive assets and liabilities that were the result of banks' policies in terms of funding and lending, investment, and so on and so forth. And just to remind you, rate sensitive and rate insensitive assets and liabilities can be classified in terms of uh, repricing, fixed and floating interest rates within a certain time period. So if we investigate a particular time horizon, so for example, 1 year, then assets and liabilities that would be repriced, interest rate on which would be changed according to particular floating rate benchmarks within this 1 year. So for example, assets with daily repricing, such as overnight loans, for example, assets with 3 month, 6 month repricing, and so on and so forth, as, for example, short-term bonds or floating rate mortgages. Those would be rate sensitive assets and liabilities. Why do we consider them rate sensitive? Well, because if interest rates that are the underlying for the interest rate benchmarks banks use to figure out the floating rate on their assets and liabilities, then they would be sensitive in terms of net interest income. To figure out the exposure of the bank to the change in interest rates in terms of their net interest income, the go-to model that is used is very simple, and it's called the repricing gap. The repricing gap is just the difference between rate-sensitive assets and liabilities. In our case, the bank holds assets for the sum of $900 million that are rate sensitive. So they're being repriced within 1 year period. And respectively, rate sensitive liabilities, so the debt that bank holds or short-term deposits that the bank holds, are equal to $600 million. So the repricing gap would just be the difference of the two. And what is the interpretation of the repricing gap? Well, that's the exposure of the bank's net interest income to changes in interest rates. For example, if the bank holds more rate-sensitive assets than rate-sensitive liabilities, then on net, if interest rates increase, the gross interest income would increase to a larger degree than gross interest expense, so the bank would on net win when the interest rates increase. But if they decrease, on the other hand, then the bank would net lose, as it would receive less interest on its assets and less interest on its liabilities. But as assets constitute a higher par value, then the decrease in gross income would not be overweighed by the decrease in gross interest expense. So as our repricing gap is positive, it would mean that in terms of net interest income, the bank is positively exposed to the increases in interest rates and negatively exposed to the decreases in interest rates. So we could simulate certain scenarios. For example, if we assume that the interest rate would increase by 1%, so the change of interest rate is 1%, positive 1%, then we could easily figure out the respective change in net interest income by just multiplying the repricing gap by the respective interest rate. So if interest rate increases by 1%, the bank net gains $3 million in terms of net interest income. As its repricing gap is positive, if the rates, on the other hand, decrease by 1%, then the bank would net lose. That's a very simple and intuitive model. Now, we need to figure out the second type of interest rate risk exposure that banks face, and that considers the economic value of equity aspect of interest rate risk. If the assets and liabilities are rate insensitive within a particular time horizon, so we can consider them as basically fixed rate assets and liabilities, then they would not be impacted by the interest rate changes in terms of their net interest income, but they would be affected in terms of their fair value. So what could potentially happen is if the bank's rate insensitive assets and liabilities are not balanced in terms of their sensitivities to interest rates with respect to their fair values, then the economic value of equity, so the difference between fair value of assets and liabilities, can decrease with interest rate changes. And that would lead to banks basically becoming insolvent and succumbing to short-term liquidity pressures. If it's apparent that the fair value of banks' assets is lower than the fair value of its liabilities, then it would induce a run on the bank. And I have explained it in greater detail in the video when we dealt with duration. So in our case, we have this scenario where rate insensitive assets of this bank are equal to $300 million, and the rate insensitive liabilities are equal to $240 million. And we also need to figure it out, calculate somehow the modified duration of both rate insensitive assets and liabilities. In our case, let's assume that the modified duration of assets is 3 years and modified duration of liabilities is 2 years. Why do we need that? Well, modified duration can be used as a proxy, as a very good approximation, at least for small movements in interest rates, of the sensitivity of the fair value of an asset or liability to changes in interest rates. So if the duration of assets is 3 years, it means that approximately, if the interest rates increase by 1%, the fair value of those assets would drop by 3 times 1%, 3%. On the other hand, if the interest rates decrease by 1% because of the present value logic and discounting, the fair value of those assets would increase by 3 times 1%, so 3%. Same can be said about the fair value of respective rate insensitive liabilities. So what we can do is we can figure out the exposure of assets and liabilities fair value to the changes in interest rates. So to do that, we could just multiply minus the amount of assets times the respective modified duration and drag this formula down to figure out the similar concept regarding liabilities. And then, as we know that as interest rates increase, both assets and liabilities depreciate in value, we need to figure out the differences in the two to calculate the exposure of the economic value of equity. So we need to figure out what is the result overall. So we subtract from the exposure of the assets fair value, the exposure of the liabilities fair value. And we see that approximately the exposure of the economic value of equity is minus $420 million. It means that if the interest rates increase by 1%, then the economic value of equity would change by the exposure times the change of the interest rates. And we see that in this scenario, if interest rates increase by 1%, the economic value of equity would drop by $4.2 million. And we don't need to account for rate sensitive assets and liabilities in that case, as floating rate assets and liabilities have the same fair value, as both the cash flow and the discount rate arguably increase and decrease by the same amount. So in that case, we can see that the bank faces a dilemma in this case, as when interest rates increase, the bank wins in terms of its net interest income, but on the other hand, it loses in terms of the economic value of equity. So that's why in interest rate risk management, it's extremely important to simultaneously look at both facets of the risk. Well, how the bank can use derivatives to offset, to mitigate those types of risk. So it's easiest to figure it out for the repricing gap. Well, if your exposure to increase in interest rates is positive and your exposure to decrease in interest rates is negative, well, then you might want to offset that exposure by paying a floating interest rate and receiving a fixed interest rate in terms of a respective interest rate swap. What would happen is that you might want to enter an interest rate swap contract with a notional principal that's equal to the value, to the absolute value of your repricing gap, in that case, $300 million. And then the sign of the repricing gap, so plus or minus, so the direction of your exposure, would determine whether you would want to pay floating or receive fixed, or pay fixed and receive floating. The logic here is very clear. Let's assume the downside. Our repricing gap is positive, so we lose when the interest rates decrease. So we would want, in terms of the swap, to be on the other side of the transaction. We would want to win if the interest rates decrease and lose when the interest rates increase, because this loss could be offset by the positive change in our net interest income. In that case, it's beneficial for us, in terms of hedging at least, to pay floating and receive fixed. So if exposure, so repricing gap, is greater than zero, then you pay floating and receive fixed. On the other hand, the exposure would be negative. For example, if the situation would be reverse, imagine that we had $300 million of rate-sensitive assets only, then the scenario would be exactly the reverse. Then we would be interested in paying fixed and receiving floating, because as the interest rates would increase, our net interest income would decrease, and we would need to offset that by the net payoff of the interest rate swap. So that's the logic of hedging your net interest income exposure with an interest rate swap, you look at the absolute value of your repricing gap, and that's your notional principal, and then you look at the sign of your repricing gap, and that determines the side of the swap you want to be in. It's very analogous to that in case of the economic value of equity exposure. Again, I want to stress that due to nonlinearity of the sensitivity of assets and liabilities fair value to interest rate changes, this is just the approximation of the exposure. But it works very well when the changes in interest rates are modest. And this exposure can be considered conservative, as due to the convexity of this relationship, when interest rates increase, the real depreciation of assets is lower than this modified duration model shows. And if the interest rates fall, the appreciation is higher than this modified duration model shows. So you could use that as a conservative estimate for the purpose of interest rate risk management. In that case, again, we look at the absolute value of the exposure and pick this value as our notional principal of the swap, and then look at the sign of the exposure and again determine whether we want to pay floating and receive fixed, or pay fixed and receive floating. In that case, our economic value of equity exposure is negative. It means that it decreases when interest rates go up, and that's very typical for banks as they undertake the maturity transformation. They borrow short-term and lend long-term, so it's very hard to find a bank with negative duration gap and with a positive economic value of equity exposure. But regardless, in any case, if your exposure is negative, then you are incentivized in terms of hedging to pay fixed and receive floating in terms of the interest rate swap. So when the interest rates increase, your economic value of equity would decrease for sure, but you would gain net positive payoff from the interest rate swap that would offset completely that loss that you make. So you'll get some cash and you would be able to provide for this decrease in equity accordingly. And if your exposure is greater than zero, just theoretically, if your duration gap is negative, for example, well, then you would want to pay floating and receive hedge this exposure from the other side. But actually, as the mechanism of hedging both types of risk are very similar when we look at swaps, we could design a swap contract that would immunize our bank completely against those changes in interest rates. And to do that, we need to consider both simultaneously. The repricing gap, net interest income exposure, would tell us to pay floating and receive fixed because the exposure is positive, and the economic value of equity exposure would tell us to pay fixed and receive floating. Those are two contradicting pieces of advice that we get from those two models. So what to do in that case? Well, in that case, we just need to sum up the two exposures, so the economic value of equity exposure and the repricing gap, or the net interest income exposure, and we get minus $120 million. We could add up those two exposures, and then the sign and the absolute value of this figure would tell us the notional of an interest rate swap and the side of the swap we want to be in if we desire to immunize the bank against both types of risk. In that case, as our absolute value of the total exposure is $120 million, we would like to enter a swap with a notional principal of $120 million. And as the sign of the exposure is negative, we would want to pay fixed and receive floating. So that is how interest rate risk can be easily managed using external hedging, in particular interest rate swaps. Now, let's investigate a slightly more complicated but arguably a more organic way of interest rate risk management that involves asset and liability management. What banks can do to immunize themselves against interest rate changes by just manipulating with the asset and liability mix that they have. So here we would have the same initial condition. So rate sensitive assets and rate sensitive liabilities are exactly the same. And our repricing gap naturally stays the same. We can take the exact same values from this case for rate insensitive assets and liabilities, so 300 and 240. And here we also need to know what are the total assets and liabilities that the bank holds. So just sum up rate sensitive and rate insensitive assets to get total assets, and rate sensitive and rate insensitive liabilities to get total liabilities. And now we still can apply the very same logic in terms of scenarios when interest rates increase or decrease. Here we need to remember our exposures for values. And the economic value of equity exposure is asset exposure minus liability exposure naturally. And the total exposure is the sum of the net interest income exposure and economic value of equity exposure. So now, what can banks do without going outside of its own business, without entering into any interest rate swap contracts, without engaging in any derivatives trading at all to mitigate their exposure? Well, it turns out that the banks can manipulate the values of their rate sensitive assets and liabilities because, well, banks have some power, some flexibility to negotiate the terms of their funding or their lending. Potentially, you could fix the interest rate on some of the loan products that you are offering. You could, on the other hand, change some of your fixed loans into floating rate loans, and that would obviously adjust your exposures, and potentially the exposures can be adjusted in a certain way so that your total exposure is reduced to zero. So what exactly should we do numerically to immunize ourselves given certain asset and liability mix that we have in the first place? Well, first of all, we need to know our total exposure, and we already know it from the last example. It's minus $120 million. So on net, we lose when interest rates increase and gain when interest rates decrease. And then we can manipulate it. We can mitigate our exposure totally by adjusting either our rate sensitive assets or rate sensitive liabilities. And these formulas over here show by how much do we need to change the value of our rate sensitive assets or liabilities to be immunized. So what is the logic of this formula? Well, if we increase our rate sensitive assets, well, we get more exposed to the net, we get more exposed to interest rates changing in terms of net interest income. But bear in mind that you cannot just get your rate sensitive assets out of nowhere. You can just renegotiate your fixed and floating rate assets. So if you want to increase your rate sensitive assets by $30 million, for example, you would need to reduce your rate insensitive assets by the same amount. And if you reduce your rate insensitive assets by a certain amount, well, what it would mean? Well, the exposure of the economic value of equity is proportional to the modified duration of your assets. So that's why the modified duration goes into the denominator as well. So bearing that in mind, let's use this formula to adjust the amount of rate-sensitive assets and rate-insensitive assets and see if we would successfully mitigate our interest rate risk exposure. So applying this formula as its delta rate-sensitive assets, so the change of rate-sensitive assets that we need to achieve, we need to take the initial value of rate-sensitive assets and subtract, as there is a minus in front of this formula, the total exposure and divide that by 1 plus the modified duration of assets. We can see that we are left with 930. Our rate-sensitive liabilities would not change and stay at 600, and our repricing gap would now be equal to 330. What we need to do now is to acknowledge that those two figures, total assets and total liabilities, do not change, because in asset and liability management, you cannot just create new assets or new liabilities out of nowhere, arguably. So we need to make sure that those stay the same when we perform our asset and liability management. What it means then is that to figure out our rate insensitive assets, we now need to subtract our rate sensitive assets from total assets. So naturally, as our rate sensitive assets increased by $30 million, our rate insensitive assets reduced by $30 million. It would mean, in terms of real business negotiations performed by the bank, that, for example, it renegotiated $30 million worth of fixed rate mortgages to now be floating rate. And whether the bank can do that in terms of business feasibility is up for question, but theoretically and numerically, you could still do that, because all of the figures stay positive and you can still maintain the same values of total assets and total liabilities. Naturally, total liabilities would not change, but just to make sure, we can subtract rate-sensitive liabilities from total liabilities and get to 140. Now, we can still apply the scenario for the net interest income change, given certain scenario, and just copy across all of the formulas that we have put over here. And we see that our asset and liability management scenario has been successful because, first of all, our net interest income exposure has increased by $30 million, and our economic value of equity exposure has increased by 90 million because our assets decreased by $30 million in terms of rate insensitive assets, and given the duration of 3, the exposure has increased by 30 times 3, $90 million. And overall, it has resulted in our total exposure just getting to exact 0. So that's how we can adjust our rate-sensitive assets to immunize the bank against interest rate changes. But we can also do the same by adjusting our liabilities, our rate-sensitive and rate-insensitive liabilities accordingly. So in that case, our rate-sensitive assets stay exactly the same, but our rate-sensitive liabilities need to be adjusted by this delta rate-sensitive liabilities. So we need to add, because here there is a plus in front of this ratio, total exposure at the very start, the exposure that we seek to immunize, divided by 1 plus the modified duration of liabilities. And we see that in that case, we would need to reduce our rate-sensitive liabilities by $40 million. And now, given the fact that we have put formulas that maintain the same asset and liability mix, we can just copy these formulas across and see how the exposures of the bank changed and whether we have achieved what we wanted. So the immunization of the balance sheet to interest rate changes. Here we can see that we have increased our rate insensitive liabilities by the $40 million that went out of here over to here. And what it meant essentially is that we have increased our net interest income exposure by $40 million as we reduce the amount of rate sensitive liabilities. And we reduced our economic value of equity exposure because we have increased our rate insensitive liabilities by $40 million. And as the modified duration of liabilities is equal to 2 years, then the change in exposure is $40 million times 2. So it increased by $80 million. And 40 plus 80 gave us $120 million. That balanced out the total exposure of the balance sheet to interest rates. Arguably, in our case, the scenario of asset and liability management using liabilities is less realistic than the one using assets, as here we have reduced the amount of rate sensitive liabilities and increased the amount of rate insensitive liabilities. What it would mean is that we would have to renegotiate some of our floating rate funding and turn it into fixed rate funding with respect to our horizon, for example, 1 year. And what that would mean is that we would need, first of all, to succeed in our negotiations, obviously, but second, we need for our durations of assets and liabilities to stay the same. So we would need to negotiate that our previously rate sensitive liabilities would be converted into rate insensitive, with their duration being, on average, equal to 2. And that's not always achievable because of basically business feasibility of these negotiations. So that's one of the reasons why in the real world, in real financial practice, banks largely prefer to resort to external hedging, just enter into a bunch of interest rate swaps or other derivatives contracts, rather than adjusting the structure of your balance sheet and renegotiating the contracts regarding your assets and liabilities. But as you can see here, in theory, it is possible for the bank to immunize itself against interest rate risk by just adjusting its business model. The final point that I would like to make regarding internal and external hedging for interest rate risk is that it is frequently said that interest rate swaps can be used to transform assets and liabilities from one form to the other. That's exactly what we have seen. By engaging in the interest rate swap for the notional of $120 million, and when we pay fixed and receive floating, we have effectively done the same in terms of our payoffs and exposures as if we would have adjusted the mix of our rate sensitive and rate insensitive liabilities. That is what is essentially meant by this transformative effect of derivatives and interest rate swaps in particular. And that's it for interest rate risk management using internal and external hedging. Please leave a like under this video if you found it helpful. I would be glad to read any further suggestions on business, finance, and economics videos in the comments below. And don't forget to subscribe to our wonderful channel. Thank you very much and stay tuned.